Hello everyone, my name is Rishita Patel and my student ID is SHH3038. Today I am here for my presentation for the topic of accounting for income tax. This is the topic from the subject of corporate accounting. So let's start with the introduction of my presentation. Here I have chosen Telstra company for my report as well as presentation. So let's start with the overview of my presentation. First, evaluate the differences between accounting profit and taxable profits. Factors that result in arising of deferred tax assets as well as deferred tax liabilities. Next, actual tax expense that the company should have booked based on the profit before tax. After that, tax is booked in the income statement. Moreover, the income tax paid figure in the cash flow statement. After that, tax payable figures in the balance sheet. And lastly, temporary and deductible differences. So let's start the concepts for my presentation and let's start with accounting profit. Accounting profit is derived after deducting all expense from the revenue. Taxable profit is the profit on which tax is to be paid. Taxable temporary differences are those that will give rise to higher amount to be paid or lower amounts to be returned for the taxes in the future years. If we talk about deductible temporary differences, so deductible temporary differences are those that will give rise to lower amounts to pay or higher amounts to return for the forthcoming years. Let's talk about the deferred tax assets. Deferred tax assets are the items on the balance sheet of the firm that may be utilized for reducing the taxable income in the future. If you look at the deferred tax liabilities are the items can increase the future tax amount that the company may need to be paid in the forthcoming years. Let's move to the next slide. Recognition of deferred tax liabilities. Here we can see that a deferred tax liability should be recognized against all taxable temporary differences. However, there are three exclusions to this requirement to recognize the deferred tax liability, which are followed by following steps. The first step is initial recognition of goodwill. Second step is initial recognition of the asset or liability other than in case of the business combination, where at the time of the transaction does not impact either the taxable or the accounting profits. The third step is temporary differences that are associated with the instruments in the subsidiaries, branches, and associated with interest in joint arrangements. The next slide represents the recognition of deferred tax assets. Here we can see that a deferred tax asset is recognized for the deductible temporary differences, unused tax credits, and tax losses to the degree that it is likely to taxable profit would be available against which this deductible temporary accounts would be utilized. The initial recognition of the asset or liability other than the business combination that at the time of transaction does not impact the taxable accounting profits. The next step represents investments in branches, subsidiaries, joint arrangements, and associates and are only recognized to the level that it is likely that the temporary difference would reverse in the foreseeable future and that the taxable profit would be available against which these temporary differences would be utilized. Let's move to the next slide, and the next slide represents the income tax expense of Telstra. This is the sum that I have taken from my report and I have deeply explained in report, but here I just explained few things, the main things. So first start with the income tax. The total income tax of the Telstra of the year 2019 is $923 million. Income tax expenses should be 921.6 million dollar. Non-deductible and non-taxable items of $38 million added in the income tax expense of $922 million. Amended assessments of $18 million over the provision of tax in previous years of $10 million. Different tax rates in overseas jurisdiction of $9 million, which is deducted. Net tax liability is found to be 923 million. The recognized income tax expense divided by other comprehensive income or equity during the year of 2019 is $13 million. Overall, Telstra paid $956 million, but $103 million belongs to the previous year. That's why $103 million is pending as a liability for the firm. So let's move to the next slide. Deferred tax assets and deferred tax liabilities in balance sheet. This topic also I have taken from my report because this is also the sum. The reasons for the difference, then we can see that the company has recognized deferred tax assets equal to 59 million in the year 2019, followed by increased by 5 million as compared to the preceding year's figure of $54 million. The next step is a deferred tax liabilities of 1,529 million, which is represent a decrease of 8 million as compared to the preceding year. The deferred tax asset is recorded due to contrast liabilities and other revenue received in advance, provision for employment entitlement, trade and other payables, other provisions, capital tax losses, defined benefit liability, allowance for the doubtful debts, financial instruments and income tax losses. Let's look at the deferred tax liabilities. Deferred tax liability is recorded due to the tax base and carrying value differences of the value of property, plant, equipment, intangible assets, deferred or contrast cost, trade and other receivables, as well as contrast assets, investments and borrowings, moreover other financial instruments and many more. Let's look at the next slide of temporary difference and permanent difference. First start with temporary difference. Temporary differences occurs wherever there is a difference between the tax base and the carrying amount of assets and liabilities on the balance sheet. Deferred tax assets or liabilities is recognized for temporary differences. If I talk about permanent differences are differences between the tax and financial reporting of revenue or expense items which will not be reversed in the future. The last slide of my presentation, that what I have learned from this assignment. So if I talk that I have learned so many things from this assignment, start with the first point, how the companies apply it in the real life. The second is how the companies recognize deferred tax assets and deferred tax liabilities. Moreover, how it is reflected in the notes of the accounts. After that, items not allowed by the tax authorities, and final point is whether taxes are confusing figures. So this is overview of my presentation. Thank you so much for listening.